Hey friends, welcome back to the channel. I'm Iggy, and I've been diving deep into topics like stocks, finance, and everything related to growing your wealth, no matter where you are in the world. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. If you're looking for that edge, stick around. Now let's turn our focus to Wall Street's latest analyst calls, breaking down what experts are saying about some of the world's most watched companies and what it all means for your portfolio. In this episode, we're going documentary style, so let's dig in as if we're exploring a major market report together. It's been a week of big moves. Analysts across Wall Street are publishing fresh ratings and bold predictions for names like Tesla, Microsoft, Apple, Nvidia, Oracle, and Walmart. These highly visible endorsements or warnings move billions in capital and act as a weather report for global investing, especially for Singaporeans and anyone building diversified portfolios. The main trend tying these calls together is a big wave of optimism about artificial intelligence and future growth. Out of 12 recent calls, 10 are positive. That's unusually bullish. The average predicted upside from these price targets is about 26%, meaning analysts believe the market still underestimates how much these giants can gain. Let's break down this optimism further. Tesla is grabbing the headlines. Deutsche Bank raised its price target to $435, suggesting a 74% climb from recent trading levels. This reflects stronger vehicle sales and confidence in Tesla's ability to lead electric vehicle adoption. But it's not just one name catching attention. Nvidia, king of AI chips, got upgrades from Barclays and Daiwa, both citing rapid expansion of AI capacity. Microsoft rose in the rankings too, named a top pick with a higher price target reflecting its edge in integrating artificial intelligence throughout its business. You can imagine AI as a giant machine working across sectors. Nvidia makes the chips, but it's not just one name catching attention. Nvidia, king of AI chips, got upgrades from Barclays and Daiwa. Both CoreWeave builds out the computing power, Microsoft provides the enterprise software solutions, and Tesla brings it to life on the road and in energy systems. If demand stays hot, these four ride the boom in different ways. When experts say capacity additions are tracking ahead, they mean data centers are racing to install more servers and chips. That's why the market expects more growth, earlier than previously thought. But of course, every thesis depends on the pace of infrastructure and adoption. Let's look at Apple. The company posted strong iPhone and services revenue, growing the core business even as some analysts warn that demand for new devices may be cooling off. Evercore Eyes raises the price target, pointing to strength in premium devices. KeyBank is more cautious, not convinced that Apple's momentum will sustain without a fresh spark. For most investors, Apple stands out as the solid, dependable choice rather than a bet on dramatic upside. This is reflected in the numbers. Strong revenue, stable returns, but investors should be realistic about the next big jump. Oracle tells a different story. It's the battleground for analyst disagreement. Bernstein projects growth and sticks with a high target. Rothschild & Co. Redburn calls for a sell, warning of downside risk linked to uncertainty in Oracle's cloud business. When experts disagree this strongly, it's a flag for investors to dig deeper and avoid following headlines blindly. For U.S. investors, each call signals where to allocate the next dollar. Cluster around AI and technology winners. Use Tesla as a high-reward, high-risk option. Look to Apple for steady growth, and treat Oracle as a speculative bet. For Singaporean investors and others trading internationally, decisions go beyond stock selection. Currency moves matter. If the US dollar swings up or down while targets rise, it can dramatically impact your real returns. Dividend withholding taxes add another layer when investing in US equities, reducing actual yields received. So it's worth tracking these implications for stocks like Microsoft and Apple. Building a portfolio in today's climate requires smart risk management. Oracle's sell rating is a warning about possible trouble in software sales. Tesla's huge upside is based on trust in new technology and competition. Nvidia's fate rests on ongoing AI demand and supply. Microsoft may be slowed if enterprises drag their feet on AI adoption, and Apple depends on continued consumer appetite for devices. So, how should you protect yourself from these risks? Use position limits. Never let one stock dominate your portfolio. Space out investments to avoid buying at the peak. Review holdings regularly, keeping an open mind if data changes. The broader environment supports growth stocks. The S&P 500 is up by more than 20% year to date, and recent central bank moves are helping valuations for tech leaders. Still, climbing prices mean future gains may shrink. That's why staggered investing, putting money to work over time rather than all at once, can be a smarter way to capture upside while managing risk. Portfolio strategies, according to these calls, cluster around time horizons. In the next 3 to 6 months, focus on AI market leaders like Nvidia and Microsoft. Over 6 to 18 months, Tesla is the speculative upside play, while Apple is the dependable compounder. Beyond 18 months, Oracle is for those who can stomach volatility, while Walmart offers slow but steady growth and market defense. Most practical portfolios benefit from a core and satellite approach. The core might be Microsoft and Apple. Satellites include Nvidia for growth and Tesla for high risk, anchored by a defensive pick like Walmart, and perhaps Oracle as a speculative watchlist name. Compare analyst estimates. Tesla and Microsoft shine as high upside bets. Nvidia remains strong. Apple is steady. Oracle is controversial, and Walmart is the portfolio anchor for conservative investors. The simplest call is to upgrade your core, Microsoft, Nvidia, on market dips, and expand into more speculative names like Tesla only as catalysts develop. In the end, selective optimism is key. The upside projected by analysts may be real, but the risks and differences between companies are huge. So conviction should live where fundamentals and adoption curves are clearest, especially around artificial intelligence infrastructure. As an investor, discipline, setting entry points, tracking size, and reviewing every few months is more important than following any single analyst target. Make sure to check currency and dividend rules, especially for international accounts. If you found this deep dive helpful, drop a comment with your own take. Are you watching Tesla's new moves or betting on Microsoft's AI ambitions? Don't forget that if you want the full breakdown, checklists, or join curated portfolio clinics, you can join me on Substack. As always, keep learning, stay curious, and remember, investing's about long-term strategy,